Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is September 4th. S&P 500 closed at 3427. This is David Zarling. I'm here with a guy who likes to organize stock jamborees, Ian McMillan. We had quite a reaction. I know last week you talked a little bit about Fibonacci extensions and the market could pause here. We don't make predictions here, but we were always open to something pausing. And so here we are. We had a little bit of reaction price-wise on Thursday, a little bit of follow through and then reversal on that today. So there's a lot to cover because there's a lot of price movement. So there's a lot of interesting developments. Where should we start?
Certainly a week that was different than the last 2 months. Yeah, back to your comments, I think we're definitely open. I mean, the retest, as we had mentioned many times, the retest of the February highs was...
And when you say that, you mean just that price had exceeded the February highs and something like the S&P 500. We were open to the idea that you could have price move back to that level.
Mm-hmm. And I think people thought that that was probably the healthiest way. I mean, the healthiest way for us to, I don't know if you want to call it a consolidation, but we got it. Didn't get necessarily in the fashion I don't think many would have liked, but we did get the retest, bounced the second half of the day. So second half of the day, good start today on what maybe is a rebound.
Could be,
not.
Between something like the S&P 500 or the NASDAQ 100, we saw from the high down to on the S&P 500, we'll call it retest level around 3380, 3390. That was a pretty quick 6.5% move down with the majority of the hurt happening on Thursday, but continuing this morning on Friday. And so now we have an interesting.
And the NASDAQ worse. NASDAQ, I think, was down about 10.3% from intraday high on the second to today's low. Yeah, they sold it real hard this morning, bought it up this afternoon. So we'll see. We'll have to see follow through on Tuesday. But it's one of those things, good streaks, bad streaks. I think we've never been shy on here about we fully expect to be pretty long anytime there's a top. We were in February.
Right.
We'll continue to be so. We were this time around. I don't know. I mean, again, and I'm not trying to say that this is anything remotely close to February and March yet. I will say this in this drawdown that we had earlier in the year, the second day, saw a lot more selling on February 25th.
Right.
So didn't quite see that same follow through today. Lots of volume, but no follow through to the downside. So is it a shakeout? Is it something more? I think closing a week below 3,400 would have been kind of a sketchy sign.
Well, and you don't just pick that out of your hat. I mean, a weekly close going back to February high was 3380. We had talked about the importance of 3400, 3390 previously, and it's because we're talking about the prior highs back in February. Typically, potential resistance that's exceeded then comes potential support, and so we'll see if that holds going into next week. But it's one of those.
It's tough because you don't know, right? I mean, if I'm back on February 25th, they sold it all day. And then they sold it all day the next day and the next day and the next day. So we did get a bounce today, but you don't know until you know.
Well, and it's a trend, right? So I believe it's 8 of the last 9 weeks were green, positive weeks. So that's a very solid, aggressive trend. So to have a red week or a negative week price-wise this week, not necessarily the worst thing in the world if you've had quite a run in price higher. A consolidation is perfectly normal, especially if we're consolidating above a level like 3380, 3390.
If we consolidate in here for the next, there's early November will be pretty big. Something's happening that the market participants like to pay attention to. And see, I mean, for presidential year seasonality, it peaks on like 9 and September 3rd. I think Renaissance Macro had a really good chart on that. They took every election year back to, I can't remember what they did. It was a lot. And yeah, I mean, you get pretty weak into September.
Well, and even regular seasonality, I know mid-September, that's when weakness is in play, typically through in October, November. But whether we get that is to be seen. Any type of consolidation that price moves sideways within a range is welcome. I mean, everybody
It'll be
loves
annoying,
it when
but
price,
it'll be healthy.
right. I mean, everybody loves it when price is moving to the moon and you're positioned for it. That's great. But
But I'd
consolidation could
rather
be
correct through
time.
than price.
Right.
Maybe we did just correct through price. I mean, I have, right? There's depends on what time frame you're looking at.
Sure.
This could be the correction, or we need to go sideways for a month or 3, or I mean, I have no idea. Obviously now, as 3,400 was a sign for many investors and traders to get long as they broke above highs. Obviously we did not wait that long, but now I guess 34 or 35.80 is that new time highs we're looking for.
Well, yeah, and I think you can say that from a technical perspective, when we look at when the selling aggressively began on Thursday, we now have a gap on our hands near 35.60. So that's going to be an important area of resistance going forward if we do move higher. So just for those following along at home, 35.60 on the upside, that's something that would have to be grinded through. We'd have to work through potential supply there. And then again, looking back at that, 33.80, 33.90 level, those are things we're going to be watching and considering, and those are going to dictate allocations and how we're positioned. But as far as uptrends are concerned, it's not like a break of an uptrend by any means.
Certainly not. This does not mean the trends are, I mean, the NASDAQ, for crying out loud, is still, I believe it closed above its 20-day moving average. There was a lot of intraday damage done, but lots of things basically came down to their 50-day moving average, and they all got scooped right back up.
Right. And so we have this situation that we had talked about before that we're open to. If you look at any market year, because we're market historians, there's several times that happen per year where you might have a 5 to 8% price correction. That's perfectly normal. Right now, it's a perfectly normal situation with that type of move. Yes, we realize it was in 2 days, but to have that type of move to test the highs, that's a perfectly normal supply and demand characteristic.
It is, and VIX still isn't ideal. I think we'd all like to see that below 20. So the fact that it couldn't really break below 22.
And that goes back to, we could see elevated VIX for quite a while as we see plenty of investors, retail and institutional, involved in the options market. That's just that tail's going to wag the dog a little bit. So
could happen. Yes.
Perfectly normal there. So we'll see, if we're breaking, like you said, below 33.90, that's a different story. Adjustments will be made accordingly. As we've talked about in the past, the distant past, it's okay to land the plane, rather be on the ground safely and wishing you were in the air than the other way around.
Yeah, I mean, that's what a buy and a sell button for, and you can sell them and you can buy them right back. So no harm in reducing risk to kind of see how this plays out. We had a very strong behavior, very clear behavior for multiple weeks, and I would say that it's some type of behavior change.
It could be. It could be
a huge shakeout, right? Because things like Apple closed green.
It could be like June. That was
could be, and we could create a 3-month range here, which when we break out of it would then be extremely powerful.
That's exactly right. So these are all potentials, right? That's part of the game planning process with adaptive, is if this price level, then that dictates allocations based on price levels. And so we continue to monitor those. We definitely had a price reaction of the S&P 500 near the 35.80, 35.90 level. And so now that's an area where we'd like to see price clear there. Maybe we consolidate below there for a while, and that's perfectly normal too. In the past few podcasts, we've talked about the relationship between growth and value and something like the NASDAQ 100 and small caps. What are we seeing? What are we seeing there?
In regards to those two indices and their relationship together, NASDAQ obviously got hit the most the last 2 days. Russell held up decently well on a relative basis. I'm not too impressed with it on an absolute basis, and we can get to that later. But that relationship still clearly heavily favors NASDAQ and the growth.
Right. We continue to see in those relationships a sequence of higher lows. And so the benefit of the doubt goes towards growth and tech for now. Rotation is still part of the game. Like that's a normal part of markets. You know, some like to focus on it almost exclusively. I don't know that that's the
There's
it's
a
something
lot
to be
of
aware of.
every time we have these moves, I got to see more. I mean, I need to see banks actually move with some conviction rather than, and again, this is something we can get to in the extended podcast, but I'm not completely sold on it. Every time we get a 2-day kind of correction in this relationship between growth and value, everyone gets super giddy. There are things like transports.
Yeah, transports on a relative basis.
Transports are strong. I mean, it was a good week overall for things like materials, utilities, staples, defense. They had a good week, but still happy with those relative charts. Semis actually had a very good week, and equal weight S&P finished flat. So I just haven't seen enough from growth value relationship to really say this is rolling over.
When you brought up something interesting there that I don't know some people realize. I mean, in the industry they do, but if you were to ask someone, did you realize there's two S&P 500s? I don't know that they would realize that there's a cap weight and there's an equal weighted. And that's an important concept, right? Something that is based on the capitalization size, and the other one is everything has the same size within the index. And that's something we monitor, right? We look at how is equal weight, because that provides clues to where strength is. And so you can look at something like an equal weight versus the S&P 500. So that's to be determined. To your point, rotation is there. We've seen it before. It's something that happens. If we were to not see something like the Russell 2000 participate, I'm not saying outperform, that would be, we've got a decrease in breadth. We might not have that rotation. So there is the possibility in the next 2 or 3 weeks that we see small caps outperform tech, but that doesn't mean the overall trend of tech outperforming small caps has been broken.
Yeah, and absolutely really would like to see the Russell 2000 above 1600. IWM closed the week. I don't know if you can call that as a technically below its June high. Yes, technically. I mean, it's not dramatically, if we had closed towards the lows of the day on Russell, we'd have serious issues. Also, this 1600, where Russell got rejected earlier this week, or 1590, we're going to call it 1600 for the sake of this conversation. But I mean, 1, 2, 3, 4, 5, 6, now 7 times over the last 2.5 years. It's a huge price period or price point.
And what you're saying is that over that 2.5 year period, when price got to the 1600 level, we saw sellers show up. We saw supply
and we broke
show
up. broke above a couple times. May 2018, fell back below in October 2018, broke above December 19, fell back below this past March, late February. So we will see. They just do not want to own small caps above that level yet.
Yeah, we'll see. And so that's something we'll keep an eye on. So pivoting a little bit we've talked about stocks a little bit. Let's talk about precious metals and let's talk rates. What are we seeing over in those?
Precious metals still consolidating, gold up above 1900. That's kind of our big line in the sand. And silver, I don't know, would you say probably looks like it's potentially building out some type of pennant?
Yeah, and a pennant for those listening is this sideways compression in price that stays within two boundaries. The high and the low continue to narrow towards each other. And directionally, if it breaks one way or the other, that's information. And so to your point, we continue to see that on an absolute basis from silver and on a relative basis versus something like the S&P 500. And
yeah, I think gold miners are actually positive for the week. I don't know about silver miners, but I thought I had seen that note.
Right. And so, in the precious metals complex, we've talked about this before, to have, silver doing well typically means that's something good for precious metals overall. That's to be determined. We'll see.
And I'd say, knowing what we know about pennants, I'd say this is a super rough ballpark estimate. I'd say most pennants consolidations, 2/3 of the time, they break in the same direction from where they came.
So the primary trend, yeah.
So we'd expect to see silver and gold continue moving up. Whether they can outperform, also big part of the equation. So
opportunity cost is real. And so we have the same type of pennant developed on the relative basis as well. And so we'll see.
And we're watching, dollar weakness there. I think Tom Brody made a good point. There's this big RSI divergence on, if you took something like Dixie, and when you don't get a bounce with such a dramatic RSI divergence,
could be dramatic.
I mean, that's a pretty bearish look.
For sure.
So we'll see. I mean, dollar below, I don't know. I mean, dollar below 91, things get a little funky.
Yeah, absolutely. I mean, we've only been below 92 for very brief periods of time since 2015. Maybe
really
a 5 or 6 month period. That's about it.
Yeah, early 2018.
Frame. Right, and that's about it. And so we'll see. That's something we're watching. Obviously, when we look at the relationship of the dollar and things priced in dollars, if the dollar's falling, things like precious metals, that tends to be a tailwind. That because they're priced in dollars, if you've got a falling dollar, you're going to have see those do well. That can be the same thing for stocks too.
And isn't it interesting that with this weakness in the dollar, we really haven't seen relative strength from emerging markets, and there's some other areas I would have expected so far. Now, again, we saw, the dollar started falling in February 2000. That was probably the largest, the last big downtrend. And I think you could argue that the dollar's been in an uptrend since 2011, and that trend may have been broken.
Right. Yes, the rate of trend may have been broken when you're connecting a series of higher lows.
Last time that happened was, I would say, January 2003. So,
well, and I think we'll see. And when you talk about emerging market areas, especially like the Latin American areas, which are very dollar sensitive, you could look at something like a US dollar versus Brazilian real and look and say, okay, that there's been weakness there in that relationship, but I think it's not until we break below something like $5 in that relationship that we're going to see any type of appreciation in Latin American, led by Brazilian stocks. So that's something we keep an eye on. We'll continue to keep an eye on. We all know that it would be great to have some differentiation, to see some strength out of some areas internationally, which has not been the case for quite a while. And so we'll keep an eye on that. We talked about growth and value. Some of the big all-stars of the market like Apple, Microsoft, and Amazon kind of had some rough weeks. Amazon was not as rough as Apple and Microsoft, but those are also tremendous leaders on the way up.
They saved them today. We got, I don't know whoever the goalie in the net was today. I don't know if it was Steve or Jay, but it was a beautiful stick save. Again, we got to start scoring some goals now on Tuesday. Got to see some follow through to the upside. But again, if we had closed near the lows of where we traded today, I'd be a lot more antsy going into the weekend.
Right, and that goes back to
nothing huge yet.
It would have broken an area of potential support that didn't hold, but it did so far. And so that's why we use price to dictate our process. We don't use news headlines. We don't read Fed minutes. We don't get caught up in narratives. And that's where I want to finish with a quote that we talked about in our team meeting this week. If the map doesn't agree with the ground, the map is wrong. And that's a quote that you brought up in our team meeting. Can you talk about that quote again? If the map doesn't agree with the ground, the map is wrong.
Yeah, so the quote is by Gordon Livingston. And immediately when I saw the quote, I knew where it kind of hit home with me was obviously in the markets, because this is truly how we view price versus all of the other data and information and noise that floats around out there. So if we say that in our instance, the ground, real life ground is price, and a map is maybe something that's supposed to be happening, or logically, if X happens, then Y happens. If you go down this road and turn left, you'll end up at the house. Well, if you go down the road and turn left and there's no house there, the map is wrong. It's not the reality that's wrong, the ground in this quote, but it's your map that's wrong. Maybe that map was correct 20 to 30 years ago when the person made it, but as of right now, in real life, in 2020, the map is wrong.
Right. And that goes back to the whole price moves first, then the narrative follows. Right? News doesn't cause price to move. Price moves, which creates the news. Wet streets don't cause rain. Rain causes wet streets. So to your point, we use price because that's the most factual information available. Being on the ground, looking at your surroundings is the most informative data we have.
For a lot of people, I would say their map is efficient markets, or a lot of fundamentals, particularly valuation models, and their signal on their map to turn left at the house is when PE ratios get too high. Well, you know what? PE ratios can go and go and go and go. And it's been going on for years. During the days of the Nifty 50, those stocks were traded at absurd PEs compared to the broad markets. It's good stocks traded at high PE. That's kind of the way I see it.
Right. It's
kind of a badge of just being a really strong stock in whatever environment you're in.
Well, and that goes back to the
people
sports analogy,
own you.
Right? Like you go to the game, you want to watch your team, but you're going to watch a couple of those guys who really like to perform, who do a great job of performing. That's the same thing with some of these stocks that quote unquote have high multiples, or, you use the term like an absurd PE. I don't know what an absurd PE is, because
I don't either, but I'm told some of the stocks I own have a really high PE, or that we own, and I don't even know what that means in context. So
right, because you can have huge PE multiples at market bottoms, and so you can't use it as signal information. It's definitely not something that's going to help you on the ground when you're dealing with fact-based information, which is price. And so that's why we use price. We don't let narratives bother us. We're open to all outcomes, regardless of who's elected or what vaccine does or doesn't happen, what things are open and what things are closed. Price is price, and that's what we're going to stick to. It's gotten us this far, and we're going to continue to use it. So I appreciate that. I like that quote. We are bumping up against the end of our timeline for the client portion. So if you guys those who are listening, want to stick on for the extended portion, you can. Otherwise, you guys have a great 3-day weekend, and we'll see you next week.
Have a good weekend, everyone.
All right, Ian, jumping into the extended portion of the podcast, digging into the weeds a little bit more. We've talked about it in the past. It's back. Implied volatility.
Implied volatility. So we got up to a VIX of 38 today, closed below 32, which I think is short term. Some people say you can't do technical analysis on the VIX. We're going to disagree with that.
Yeah, just think about it. You could do it. But
if you just think about it, I think I'd like to see it below 25. below, I mean, I like to see it below 22, 20. I mean, I like to see it below 17, for being honest. But we've got a long ways to go before we get there, probably. So 38 was also the VIX peak at October in our Q4 2018.
Okay, so
So
during some of that volatility back then.
Yeah, and so if you want to use the VIXs, I don't know. I was a lot more nervous on Christmas Eve 2018 than I am today. So,
well, I think that's because we have important levels right below us here at the 3,400 mark that really can help guide the risk management process. It's always easier when you have a defined price level to
3,400, 39.90 so clear with that. Right. I mean, that is such a clear long above, short below, or at least massively reduced risk below.
It's binary, right? If this, then that. If above 34, if below 3,400. And so that's where
and they stepped up right there today.
Right. And while VIX is elevated, it could remain elevated for a while. I know in recent market history, a VIX below 20 is quote unquote healthy, or it's, something that's great for price appreciation. But there's also been market periods in the past. We've talked about it on here ad nauseum. I feel like the late 90s, 97, 98, 99, where you had price appreciation and high VIX. In fact, Lawrence McDonald had a good chart that he put out talking about the top 20 highest VIX readings. And when they lined up with the S&P 500 being at an all-time high, we've just had that take place, back on Wednesday. That was happening frequently in the late 90s. It's just something that was there. And so,
well, yeah, I mean, look at from 96 through October 98. I mean, you had VIX go from 10 to 50. And I don't know off the top of my head how much the market was up during those 2-3 years, but it was a lot.
Right.
And then yes, VIX started to come down in 98 and into 2000s. But the correlation was there for multiple years.
Oh, absolutely. And that goes back to, I think people just kind of have to embrace it.
Yeah, 99 is, I guess, when VIX began to fall. But
right. People just need to embrace it and understand that that's a market environment that exists. If you're going to sit on the sideline because VIX is above 20, you would have missed the majority of this run. And
you would have missed, absolutely you would have. And for some, maybe their risk tolerance calls for that. I mean, a VIX, only being involved with a VIX below 20, there's no way that can't be a real strategy. But
right.
I would hope not.
Volatility can happen to the upside, and in fact, it happens so dramatically. So, and to our point about an elevated VIX, and it can apply to the upside as well. And we saw just a dramatic move once we broke above 3,400. It also put us in a position where something like the S&P 500 was over 15% away from its 200-day moving average. So the prior 200 days of information average, it was 15% away from that, and that's statistically significant. We've seen price, whether it consolidates or pulls back towards the 200-day moving average, that's something that can happen. But it also happens more frequently coming off of bottoms. Does that sound familiar? So meaning, when we look back at the bottom in 0809, it was elevated above 15% away from its 200-day moving average for quite a while. And so that doesn't mean it has to, pull back, but we just did, and that's perfectly fine. And we saw plenty of instruments. I know you noticed this during our process, that there were a lot of things testing their 50-day moving averages.
A lot of things testing their 50-day. A lot of things, importantly, holding above their 20-day, which is kind of crazy to think about. I mean, that just shows that how far we had run up, that we could fall 6-7% and still kind of close above. I mean, we're still in an incredibly strong, healthy uptrend going on if we're using closing prices.
Exactly. And so it's one of those things where volatility can happen to the upside. We have, on the past on this show, we've talked about different candle formations, whether it's dueling tails or dojis. What did we see this week out of things like the S&P 500 and the NASDAQ?
Yeah, I think another version of I would call it short-term indecision.
Right.
We got big red bodies.
Yeah, it's
that
not exactly
pretty much
a doji, but
yeah, I'd say we pretty much gave back last week's gains, but with these huge upper and lower shadow.
well, and it was like a 6% range, right? The upper and lower shadow, upwards of 6%, something like the S&P 500.
Yeah, and then
That's a pretty big range.
10 on the NASDAQ.
And so it's not a doji, but if, it's also not a massive bearish engulfing. Could we see this turn into some type of reversal from here? Sure. But that goes back to the 3390 deal. We'll know that if we're breaking below that level and take it from there. But we do have, if you're a technician and you pull up a weekly chart, with weekly price being more important than daily price, it's pretty impressive how big the upper and lower tail on these weekly
it's
you look back in history.
Very impressive. I mean, so you basically have the body. If we want to call the body, like on something like the NASDAQ, 3%, then you've got 3% below that as the lower shadow and 3% above that. I mean, there's a lot of behavior in this week.
Right. That's
a lot of behavior. I'll put it that way. I know that sounds weird. That's just how we kind of think about it.
It's almost on the 11%. That's pretty.
Yeah, it's like 10.5% candle or range on the Qs this week.
Well, and to give people an idea,
things like go ahead.
Well, I was just going to say, to give people an idea, that the week of March 2nd, that range was about 8%. So back during the corrective period, you also had obviously some tremendous volatility. And I'm not trying to correlate the two as far as corrective, meaning that some type of correction is about to unfold. It's just giving people perspective on something having a range of 10 to 11% from a high versus during a corrective period, which also had like an 8% range. So it was impressive volatility this week, and it all happened Thursday, Friday.
Absolutely. Right. So I think this goes back to kind of something I touched on briefly at the beginning, good streaks, bad streaks. I think everyone knew that some type of corrective behavior was coming, but I could have said that like the second week of August.
Right.
And gotten nervous about it and seen, the Qs had this big daily RSI divergence, and you'd gotten nervous about it, but I guess this is kind of the price you pay for riding out these past 3 weeks. And you don't know that it's going to end till it ends. And we don't even know if it's over. So,
well, and it's still,
maybe we go sideways,
and it doesn't.
I would lean sideways, just given like this range that we had. It just seems like we've set ourselves up for a nice consolidation.
Yeah, that would.
It
seems like the most
maybe
likely.
I'm being too ideal.
No, that seems like the most likely scenario. I think another scenario that we could be open to is coming back all the way to something like, now tell me what people would do. What would investors do if we pulled back into something like 3260, where we're filling the gap or going back to the gap from February? You can't tell me people wouldn't be loading up short there. And if we moved higher from there with all that firewood stacked up.
Yeah. I mean 3260.
Yeah. And so we'd be filling that gap on because, something like the Dow Jones too is still working on its gap from February. It's not to all-time highs yet. And so
that was disappointing. We got through it and then kind of blah.
So
lost it.
Yeah. And so you talked about the Russell 2000 at 1600
What
level.
about the gap? There was also a gap that same around, now we're going to get 3265, but that same gap from August 3rd.
Yeah. Yep.
And that's all. Oh, why do they always gap it on Monday? I mean, they're always doing tomfoolery on Monday mornings.
Yeah. Well, and that's a characteristic of this market now.
Yeah.
Right. It's
and that's
just
kind
something.
in this whole, I mean, that's definitely started a long streak of these Monday morning.
Yeah, it's not a new
apps.
development. That's something that's been around. And so to see that continue shouldn't be a surprise. If there is some type of gap up on Monday, that should not surprise anybody. I don't know that happens. No idea. We could reverse. We could be down testing that gap from February and something like the S&P 500 because that's what markets do. They fluctuate.
That is what markets do. And I think, I'd said this the other day that I thought, or I said this yesterday, that I thought Friday, given what happened Thursday, I thought Friday would be more important. I mean, I'm not saying that it's going to be less painful, but I thought today would be more important to see if we got follow through to the downside. We didn't. Doesn't mean, again, it doesn't mean it can't happen on Tuesday. I like the lower shadow. I like that we closed well off the lows. So,
well, there's a lot of those, right? There's a lot of lower shadows that, we talked about off of the 50-day moving averages where we're testing average price from the past 50 days. And now we have a bunch of lower shadows on our hand in a lot of different names and indexes. And
you take the FANG index, you're looking at XLK, XLY, all of these coming right down. XLK basically into its 50. XLY is so strong that it held its 20. Microsoft actually cut below its 50-day. BABA, just lots of, we have some just stocks that had run so high up and still, are just consolidating. I certainly don't, I hope King Griffin isn't listening to this. Please don't make me pay for this. I'm definitely not as nervous as I was on February 25th. It's 25th and 24th.
And some of that has to, that goes back to, we have a nice line in the sand here. You just came off of a 2.5-year period with 20+% corrections.
Mm-hmm.
We still have sentiment out there that does seem to be actually very diverse. I know some people would say, oh, we're in the part of the cycle where retail is giddy, but I also see a part where I see that some people seem to be thinking that the next foot is going to drop and we're just going to roll over hard. I don't know.
Yes, the top callers have been very quick. There's a lot of angst out there still. A lot of disbelief. A lot of it comes from kind of the fundamental side that PE ratios and how can stocks be this high with unemployment where it is, or with all these small businesses shut down. And I know that there's pain on Main Street. I don't know any local small businesses like Nancy's Hardware that are publicly traded. So while those are struggling, Apple is not. Software stocks are not. Retail stocks are not. Large retail stocks are not.
And that's the reality on the ground.
And that's exactly. And I'm not saying that to be dismissive of small business owners or what is going on in the middle class, not just across the U.S., but all across the world. And I'm not trying to be
I know you're not being
jerk about it, but
right.
I'm just saying that I know that you see unemployment, and I know you see your local restaurant that can only have 25% capacity. I know people, we have friends that are laid off or friends that are struggling or working, all these things. That's not the S&P 500. That's not the NASDAQ. That's not Apple. That's not Amazon. And whether you think that that's fair or not, that's for other people to decide. I think that's a big other myth. Is it like the markets just aren't fair? The way they're weighted isn't fair.
Well, I think too, sometimes you also have to be aware of the narrative versus what you actually see. And I know you talked about price, but I'm also talking about, for example, I walked down Main Street here this afternoon. I saw a couple windows in them with for hire signs.
Oh my gosh! I
could restaurant around
how many for hire signs we have around here.
There's a restaurant around the corner where I live that just put in a massive outdoor patio.
Mm-hmm.
So
someone had to build that.
Right. And so I don't want to, I'm not saying that there aren't businesses that are struggling or that have closed, but I also know anecdotally when I look at what's happening on the ground, I'm seeing people get hired. I'm seeing people switch jobs. I'm seeing, so there's job flexibility there. I'm seeing, people wanting to hire. I'm seeing construction projects. Just across the street, someone's doing a construction project. I'm seeing people doing all sorts of improvements to their house. And so
home values are skyrocketing.
And now we've gone down a fundamental rabbit hole too far on this show because we focus on price. But I also want people, it's a bigger point that I'm trying to make. Don't be so naive and spoon-fed from what you see on TV to think that's 100% accurate. Question the narrative in your life on whether that's actually the case based on what you're seeing. And those are some of the things that I see that give me hope, plus the fact that the market is a future discounting mechanism, and we've been seeing it basically erase the pandemic crash. And now we're maybe in a period of a tremendous resurgence, which we've talked about on the show before, that if the pandemic wasn't as bad as we thought, and they did all this stimulus and injection, it's like steroids, right? This whole thing is like on steroids.
It is. And there's a liquidity issue. If you give someone a bunch of money to fix a problem, and then the problem wasn't as bad as you thought, or there really wasn't a problem at all, you got a lot of money sitting around that needs to be put somewhere. And it's not going to be put in cash, because cash gets you 0%.
Right.
Probably long-term not going to be put in fixed income, because you're getting paid, I don't know, 70 bips on
$7,000 on $1 million
treasury note. Yeah. So if you can borrow, if you're a business that can borrow to expand, if you're an investor that can, right? And I think actually the S&P yield is higher than the 30-year treasury. So you get more money hanging out in blue chip equities than you do in a treasury. I know the risk isn't the same, but for people that are looking for cash flow, the people that need cash flow, right? There are people out there that their retirement plan is built for monthly cash flows. So that's just the way some portfolio, it's the way it works.
Right. And so while we understand that there's narratives out there and there are real people that are hurting, I've also seen the opposite taking place. And that's a thing we can be excited about and happy about. And so swinging back into the technicals a little bit, what are we seeing we talked about rates there for a second. What are we seeing out of treasuries? What are we seeing out of like an instrument like TLT, something like that?
Flat, just like rates, flat. I know there's big move in rates today. We'll see. Banks are kind of the annoying little brother that until they get their act together, I don't really want to hang out with them.
And speaking of we do have to continue to talk about the potential of a double bottom in rates and a
we
double
do.
Top in treasuries.
And treasuries, is a
that
major.
Evidence hasn't been eliminated yet.
No, until we get, until we're above 172 on TLT, I would say momentum's pretty weak. I'd like to see a TLT get over, below 30 on an daily RSI. I don't know. It's something we touch on a lot. If there's the potential there for a 30-year upswing in rates, if rates can go down for 30 years, I bet they can go up for 30 years. So,
well, they typically move in 35-year cycles, and that'll be interesting to see what happens to a 60-40 portfolio.
A 60-40, if you're dead set on so bonds haven't gone anywhere for 6 months. The S&P since early March is probably up, 15%.
Right. And bonds have just traded sideways.
Sideways. Your tips have been fine, but
yeah, inflation protected securities have been fine. Clients are familiar with those, and
J&K's much better. So high yield bonds look much better than treasuries.
Oh, absolutely. And in fact, when you look at their weekly consolidation going back to July. That's a healthy consolidation where something like J&K is sitting above, the 104 level. Or like HYG is another one sitting above. It's still above that weekly high back in June, where that was a close of 84.50-ish. So it's above there. Those are quality characteristics out of those things that tend to operate in the same direction as equities overall. And that's a good thing. And so not all bonds are the same, is your point. We talked about equities and different weekly candles and those things. And we also, early in the show, talked about gold and silver, precious metals. How about a little industrial metal known as Dr. Copper?
Dr. Copper.
What are we seeing there?
Back above 3. Nice candle today. So good sign, economic sign. Lumber finally bounced today. It had a couple pretty rough days, but
it had such a run. I mean,
such a run. It's actually still above its 20-day. Holding above 800 or 790, I'd say. And again, we can be building ranges in a lot of things. Maybe we're not. Maybe it's not just equities we're building ranges in. Maybe it's things like lumber. Maybe it's things like rates. So we'll see.
Yeah, we will see. And
there is, again, now while we are technicians, we manage our portfolios with price, you have to be aware that there are also billions and trillions of dollars that are not managed on price. And so if you want to talk about trying to think about how other people think, right, that's kind of, I'm not saying you have to be 2 steps ahead of them, but you do have to realize who other people who are participants in this market and have, money to move the market around. They do think in regards of things like I'm nervous before the election, or again, things, stocks are overvalued, or so I don't think seeing a sideways market for 2 months in multiple assets would be incredibly shocking. Again, annoying, definitely annoying, but not shocking.
Right. It'd be perfectly normal. And to be frank, when we think about fundamentals and price, I think what many don't realize is that when we study price, we are studying fundamentals, because the collective opinion about the fundamentals are reflected in price.
That's true.
So that's why we do it, because the opinions, the collective opinions of the marketplace by those involved. And I would also argue that those not involved, right? Because if you're not involved, many people who are not involved might not have an opinion, or that's their opinion to not be involved. And so the collective opinion of the masses is reflected in price itself. And so that's why studying price is so powerful. So we're bumping up against the end of our time. Anything else you want to touch base on before we wrap it up?
I'd say trends are healthy. Markets are healthy. Momentum. You want to talk about something like 14-period RSI on, certainly on the NASDAQ, the S&P. We are, no divergences yet, right? We had a big divergence coming into late February. I see nothing but very strong momentum that we might just have to learn with how to deal with quick 5 and 6% corrections over a handful of days going forward. That might be the environment we're in here for a few years.
And that's quite interesting that you say that, because that was another characteristic from the late 90s. You had quick moves like that happen in a few days.
And they suck.
And they suck.
You underperform when you're overweight, but
right. But you ride the trend. The trend is your friend. And so I appreciate you, Ian. I appreciate the time and insight that you provide on a daily and weekly basis. We appreciate all the people who provide feedback. So we appreciate that. Listenership continues to grow, and we appreciate that as well. So with that, we got a 3-day weekend coming up. I hope everybody gets to relax, enjoy some time with family and friends. And until next Friday, have a good one.
Have a great weekend, everyone.